People often believe that you need tens of thousands of dollars to start investing seriously, but they're wrong. In fact, with the right strategy, it's entirely possible to turn $1,000 into $10,000, and then into $100,000. This exact strategy has been used by ordinary people for decades, yet it remains one of the least taught concepts in personal finance. For example, take the story of David Bach, a well-known financial expert who shared his experience with this very strategy on Good Morning America back in 2011. He explained how he turned just $1,000 into $10,000 using what's called the snowball method of investing. Now, I know some of you may be thinking, how is it possible to make money like that? Well, let me tell you, it's not rocket science. The snowball method works by starting small and letting your investments grow exponentially over time. The key is to invest a fixed amount regularly, usually on the same day each month, into a high-yield savings account or a low-cost index fund. As your money grows, so does your investment portfolio, allowing you to reinvest your returns and further accelerate growth. To illustrate this in action, let's look at an example. Say you start with $1,000 and invest it in a high-yield savings account that earns 2% interest per annum. Over the course of 1 year, you'll have earned around $20 in interest, bringing your total to $1,020. Now, here's where most people would stop, but not if they're using the snowball method. Section 1, Investing for Compound Interest. One crucial concept that's essential to understand when it comes to growing wealth is compound interest. Put simply, this means earning interest on both the principal amount and any accrued interest over time. It's like a snowball rolling down a hill, gaining speed and size as it goes. Let's take our previous example further. If we reinvest that $20 in interest earned in year 1 into the savings account, and it earns another 2% interest per annum in year 2, you'll now have around $1,040.01. In just 2 years, your initial investment has grown by over 4%. Now, if this sounds too good to be true, just remember that this is exactly how compound interest works. Many financial experts will tell you that investing for the long term is key, and it's hard to argue with that. Warren Buffett himself has said, "Price is what you pay. Value is what you get." So, if we're looking at a 2% return per annum over the course of 10 years, our initial $1,000 would grow to around $1,261. But here's where most people go wrong: they stop investing once their money has grown to this point. They think they've made it and can take a break, but that's exactly when you should be reinvesting those returns to keep the snowball rolling. Section 2, Dollar Cost Averaging. One common mistake investors make is trying to time the market by buying in during high points or selling at low points. The problem with this approach is that it can lead to emotional decision-making, and when emotions are involved, logic goes out the window. Instead of trying to predict which way the markets will go, a much more effective strategy is dollar cost averaging. This involves investing a fixed amount regularly into your investment portfolio, regardless of what's happening in the markets at any given time. For instance, imagine you're investing $100 per month into an S&P 500 index fund that tracks the performance of the U.S. stock market as a whole. When the market is high, your investments will buy fewer shares than when it's low, because each share costs more. But over time, those lower average prices will even out to give you an overall return that closely matches the market. Let's look at some real numbers here. From 2009 to 2019, the S&P 500 index fund returned around 14% per annum on average. If we invested $100 per month into this fund for 10 years, our total investment would be just over $12,000. After compound interest and reinvestment of returns, that would grow to an astonishing $45,000. Section 3, The Power of Dividend Investing. One often overlooked aspect of investing is dividend stocks, companies that pay out a portion of their profits as dividends to shareholders. These stocks offer two distinct benefits: regular income in the form of dividend payments, and potential long-term growth through increasing share prices. To give you an idea of just how powerful dividend investing can be, consider Johnson & Johnson, J&J, one of the most consistent dividend payers on the market. From 2009 to 2019, Johnson & Johnson stock returned a staggering average of over 10% per annum, with annual dividends paid out at around $2.50 per share. If we invested just $100 per month in Johnson & Johnson for 10 years, our total investment would be around $12,000. But after reinvesting all dividend payments and interest earned on our investments, that amount would have grown to over $80,000 by the end of 2019. Section 4, Risk Management with Diversification. While investing in individual stocks can offer high returns, it also comes with significant risk. If one or two companies experience a downturn, your entire portfolio could be impacted. To mitigate this risk, most investors turn to diversification, spreading their investments across different asset classes and industries. For example, imagine you're invested 50% in US stocks, 20% in international stocks, and the remaining 30% in bonds. This diversified portfolio would allow you to ride out market fluctuations and protect your investments from significant losses. To illustrate this concept in action, let's look at a hypothetical scenario where we invest $10,000 into such a diversified portfolio. Over the course of 5 years, our returns might be as follows. US stocks, 8% average return per annum. International stocks, 12% average return per annum. Bonds, 4% average return per annum. After compounding these returns over time and reinvesting all interest earned, we'd see a total portfolio value of around $21,000. Section 5, Putting it all together, a real-life example. Now that we've covered the individual components of this investment strategy, let's put them together to create a real-life example. Meet Sarah, who starts with just $1,000 and wants to grow her wealth over the course of 5 years. Using the snowball method, she invests $200 per month into a high-yield savings account that earns 2% interest per annum. She also reinvests all interest earned each year, taking advantage of compound interest to accelerate growth. In addition to this core investment strategy, Sarah diversifies her portfolio by investing 30% in dividend stocks like Johnson & Johnson and Johnson's rival, Procter & Gamble, PG. This will give her a steady stream of income from dividend payments while also providing long-term growth through increasing share prices. Over the course of 5 years, Sarah's initial investment grows to an astonishing $23,000. She achieves this by letting compound interest work in her favor and reinvesting all returns regularly, not to mention earning 8% per annum on average through dollar-cost averaging. Conclusion. In conclusion, turning $1,000 into $10,000, and then into $100,000, is no pipe dream. By using the snowball method of investing, dollar-cost averaging, dividend investing, and diversification, anyone can achieve remarkable wealth growth over time. Remember that this strategy doesn't require tens of thousands of dollars to start, just a small amount each month, consistently invested for years on end. And by letting compound interest do its magic, even modest investments can snowball into life-changing sums. So don't be fooled by the idea that investing is only for the rich or sophisticated. With this strategy, anyone can build wealth and secure their financial future.